Hello and welcome to Investors Hangout, your trusted weekly guide to making smarter investment decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, today's discussion is especially important for a very large, fast-growing group of investors, the senior citizens. We've received several questions from retirees who say things like, I don't want very high returns. I just want steady, reasonable, predictable growth over the next 3 to 5 years. Which mutual fund categories can actually help me achieve that? To answer this question and many others related to senior citizens, we have with us our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
To begin this conversation, most retirees, they rely on fixed income, fixed deposits, or senior citizen savings schemes, small savings schemes. Why do you think retirees must consider mutual funds as well for this time frame?
So there is no straitjacket answer for all retirees. Every retiree is unique and they need to be little careful about how they approach their investments in their retirement, because their tolerance has come down, or the fact that your earning comes down or gets down to becomes zero many a times. Then you need to be little careful, because your attitude to any decline changes. First and foremost, the people who will be entirely dependent on investments for their income, even that can be segmented into 2-3 categories, which means that somebody has 30 lakh rupees and all the money income that will be generated will be consumed, and his dependent on that is very strong. So for him, if all that money is invested into senior citizen savings scheme and post office MIP, that is good enough. You can't take chances with that. The only risk of this plan is that this money that you are deriving, if it is good enough, then it will not be good enough 5 years from now. You need to do something. Either save the money that you are earning from this and put it into equity, or that will be a very nominal account. The second is to reduce your expenditure. There is no third way of doing, at this age, work towards create a revenue stream, or your hobby, if it can be turned into some kind of income producing engagement, that will be a very desirable thing. The second category will be the kind of retirees who will require some kind of supplementary income. They will get their pension, they have some source of income, and that is good enough for their needs. But once in a while, if they get some money, they will be happy. You can approach it conservatively, invest, and have a quarterly and a small part of your money, maybe 5%, 10%, 20%, but it is entirely a function of scale. What is the supplementary income requirement? But you are still taken care of. Third could be a person who does not need income, does not need any supplementary income. He is more than, his pension or his income avenues are more than enough. Or his expenses are way too low. Even his risk tolerance comes down. Ideally, there is absolutely no problem in having a 100% equity portfolio. But because you have gotten older and you just don't want the headache of worrying about something when it goes down, so being little conservative with your long-term investment. So these three retirees are of completely different kind. We did a cover story on a safe pension strategy for all retirees in the December issue of Mutual Fund Insight. And what we found was allocating 50% into equity, 50% into fixed income turns out to be the sweetest spot, because what we did was we went back 30 years and looked at 10 years time span at different point, every 5-10 years, how the next 15 years looked like. So there were also phases which had 2008 in between. That was the worst phase for the market. We saw the biggest decline. And then we realized that 100% equity portfolio went down by 65%. You lost 2/3 of your money in value. Then we had 50-50 portfolio, which also went down by 30%. But that 30% was for a very brief period. But overall, the downside experience or the blow that you get in your retirement with your investments, which could be sizable, that was the ideal one for any person seeking supplementary income, and for any person who does not require any income from his investment. For them, this 50% turns out to be the best, most palatable thing. For the person in need for income, he needs to plan it a little more meticulously. He has to build a hierarchy of risk that he will assume. First is that for this principal money, it will be in guaranteed savings. Senior citizens, you are assured of return, and that you will definitely get, your every quarter. Then the post office monthly income, that you will get every month. And then some fixed deposit too. But it is entirely a function of scale of your investments and the money that you require on a monthly basis.
Right. So for the amount that one is investing in mutual funds, can you please help us identify some mutual fund categories that really fit this requirement?
Let's deal with it in terms of different needs for different investors. For the investors who need a single fund solution, and they happen to be the most fortunate, the most affluent, that they don't have any income requirement from their portfolio, they should invest in a fund called hybrid balanced. Half of the money is in equity, half of the money is in fixed income, and they have a range of 40 to 60% into equity or debt. Because of these funds, you don't lose your sleep even when market crumbles. And you are able to participate reasonably into any market rally, and it certainly protects the worth of your capital over a very long period of time as well. The second category, who need for some kind of periodic supplementary income, they should also think of this investment. The only difference is that they can mount a systematic withdrawal plan. Make it that you're not taking more than 2 or 3%, that too on a quarterly basis. And this could be little negotiable, or you may not you may not mount a systematic withdrawal plan. Take out 2-3% annually only when you need it, so that the rest of the money keeps working. And in both the cases, you will not lose your sleep. The first stage, the people needing income from their investment, they need a careful planning. They need a careful planning that they have to develop a hierarchy of risks that they will assume with their investment. The first thing, they should fill it up, and that is a function of scale. What is your scale of investment, and what is your income requirement? If your income requirement is less than 3-4%, then you should just blindly go and invest as much as you can in the senior citizen savings scheme, post office monthly scheme. So that will take about 40-50%. But you will be in a position to derive guaranteed income from this. Rest of the money, put your money into a balanced hybrid or similar such. You can also well go up to, if 50% is invested into guaranteed income, then maybe an aggressive hybrid fund will also keep your overall allocation to about 50%. And that way you will be able to tide over any kind of market turbulence of a serious kind as well. There are investors in their retirement who will have some definite spending plan, that this is the money which you need after 2 years, this is the money which you need after 3 years, this is the amount of money that you need after 4 years, and it could be for any purpose. Those investors should look at money within next 2 or 3 years should be into short duration funds. If it is a separate allocation from the pension requirement, because you need to look at your pension or the regular income need differently from all other kind of periodic spending plans or spending plans or whatever you might have, or contingencies. So consider short duration plans, funds for shorter period. Conservative hybrid funds are very nice for people who are investing for 3 years and more, but less than 5-6 years, and you definitely need that money. If it is an independent corpus or a earmarked money, consider that, and that way you will be able to keep your money in a manner where very likely you will beat inflation too, not just fixed income.
Right. Now, for monthly income, should senior citizens depend on dividends or an SWP? Because dividend here is a very confusing term for a lot of people. So if you can clarify that.
One is that if in mutual fund, don't consider dividend as a sign of performance.
Yeah.
You can invest 1 crore of rupees and the fund can give a dividend which can come back to you tomorrow. You invest today and tomorrow you get the dividend because the fund chose to give its dividend. Your principal will come down to the extent that the dividend is paid to you. Money does not grow dividend is not a sign of performance. It could be a limited sign of performance, but it may not be a sign of performance as far as your investment is concerned. There is a reason why dividend might be interesting for some people. There is a reason why dividend may not be desirable for some people. One is that dividend will be paid by fund companies as and when they decide it. The scale, the quantum will be of their choice. In systematic withdrawal plan, you can plan your cash flow requirement, that you need 50,000 rupees a month, you need 30,000 rupees a month, you need 10,000 rupees a week, and you can plan it accordingly. That every week on Monday, I want 5,000 rupees, and that much money will be redeemed from your investments. Your rest of the money will keep working. All your money will keep growing or riding the plan that you have chosen. But you will have a predictable cash flow. The difference, the tax difference of these two things is that if your income, dividend will be considered as your income. And if you don't have any other income, then you fall into the tax, your zero tax bracket. And if you have some other source of income, and if you get into a higher tax bracket because of this income, then it is avoidable. So it is a tactical decision to take. Second is that you cannot bank on dividend for your predictable cash flow, but then you always have a choice to redeem as and when you need it. So be guided by the tax, and if you want to depend on this for your income needs, go for SWP. And for initial years, it is not that significant. The difference is not significant, and overall, it may not be higher. Even in the highest tax bracket, the systematic withdrawal plan will be superior, simply because capital gains taxation is at lower rate than your the highest tax bracket. That's one. Second is that in the initial years, only the capital gains is subject to taxation. And in the initial years, substantial part of your withdrawal, the bigger component of that is your own principal.
All right. Well, thank you, Dhirendra, for giving this clarity.
Thank you.
Hope this episode helped you figure out what kind of retiree are you, in which bucket do you fall, and you also have a comprehensive framework about investing and withdrawing your own money. Well, that's all we have for you in this episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.